Pin bars. It does not matter where you started your trading journey. The internet did everything it could to cram them down your throat. This classic staple of price action trading is constantly touted as a powerful reversal candlestick pattern and a must-have decision-making tool in your trading toolbox. The problem is that all of these allegations are backed up by nothing else but a towering pile of anecdotal evidence and cherry-picked setups. So the question remains, should you believe the hype? Now you know the drill with our QuantTake series. We're not taking trading lessons from professional marketers and SEO experts. If pin bars are that powerful, then I'm sure there must be some solid quantified evidence for it ready to be dug out, right? Right. So today, we're gonna strip the pattern out of its objectiveness by running the actual numbers and put the hype to the test, objectively, exhaustively, and with the long-term data to back it up. Let's get it. What I think about price action trading in general is no mystery to my subscribers, and for good reason. But at the same time, I realize that not every single one of you coming for the first time to this channel is doing so with the same level of background knowledge. And it is my duty to expose you to the truth of the matter when it comes to those price action supposed no-brainer concepts. So for the purpose of this video, I took one for the team, I pinched my nose and went dumpster diving into the content of some notorious price action gurus in order to get a better idea of what criteria, in their eyes, qualifies a candlestick as a proper pin bar. Because after all, we want to do the concept justice. And as it turns out, as quantitative traders, we actually lucked out with pin bars. Unlike most price action concepts that are grounded in subjectiveness and conveniently use it to blur their tracks in order to escape scrutiny, pin bars on the other hand offer the advantage to be quantifiably definable in such a way that anyone or even a computer could rely on a set of objective criteria in order to spot every single one of them flawlessly, reliably, and consistently without erring once on the side of interpretation. Now a pin bar can obviously be both bullish and bearish. For the purpose of the definition, I will focus on describing bullish pin bars. All you have to do for bearish pin bars is simply flip the characteristics on their head. So what did I learn about the objective characteristics that make a pin bar worth its salt in the eyes of the price action religion? From a bird's eye view, a bullish pin bar is a candlestick made up of a small body in the direction of the candle's impulsion, a long tail wick, and a small head wick. In quantitative terms, after watching 10 plus videos until brain fog settled in, a consensus became apparent that a state-of-the-art bullish pin bar had to have the following three criteria. It is a candlestick made up of a long tail wick that is at least 50% of the entire candlestick range, the open to close range should be positive, and the head wick should not exceed 25% of the entire candlestick range. In fact, the shorter, the better. And obviously, the sum of the tail wick plus the body plus the head wick should equal 100% of the candle's range. This study today is meant to exhaustively depict the true value of pin bars, so for that reason, I tested them across 4 different asset classes and over as much reliable data as was available to me. In particular, I tested pin bars on daily frequency on equities with the S&P 500 index using SPY since February 1993, on precious metals via gold using GLD since November 2004, on energy commodities using oil by chaining the front month futures contract since June 1999, and finally on Forex using the EURUSD pair since January 1999. This provided me respectively with 7,337, 4,359, 5,717, and 6,056 rows of data to work with. That's a total of 23,469 data points to feed the study. Not bad from a statistical point of view. Now, even though pin bars can be defined algorithmically, there is still no hard and fast consensus about what precise proportions a proper pin bar should exactly consist of because, well, pin bars are still about price action in all of its subjective glory or lack thereof. Due to this, I had to resort to cluster my tests in 5% increments of proportions for both the tail wick and the head wick. The body proportion being calculated as the difference between the total range of the candle minus the added proportions of both the tail wick and the head wick. My goal there was to cover the whole spectrum of proportions within the constraints defined earlier, so as to avoid any criticism that somehow I did not test that very specific range that would have magically shown the almighty power of pin bars. In fact, as you will see, I stacked the results in favor of pin bars. So I first built the parametric density map to gauge the long-short bias as well as determine the ideal pin bar proportions that maximize all-out performance. I tested the average outcome of all trades had we entered each qualifying pin bar at the close and held the position for X bars, with X being comprised between 1 and 10 bars, and by using no stop loss, I picked an optimal holding period and I tested what the outcome of all trades would be, assuming that we did not use a stop loss first, and then assuming that we did use a stop loss just under the opposite extreme of the pin bar, like for example below the low for a bullish pin bar, which looks to be the risk management scheme of choice most commonly recommended by price action junkies. Lastly, I discarded all pin bar proportions that did not yield at least 100 long and short setups across the data sample in order to keep the study somewhat statistically significant. One thing I need to point out, as I just mentioned it earlier, the study was skewed to favor pin bars by omitting any trading costs or slippage and by heavily optimizing the statistical picture. That is totally unrealistic, I know, but I did so in order to see what pin bars can generate in an absolute best case scenario. The logic here is that even if a best case scenario is not appealing, then we know what to do with the object of the study. With these preliminary caveats now out of the way, here are the results. Starting with the S&P 500, and as shown in these tables, the first thing that we notice about pin bar signals is that the long side expectedly outperforms the short side, which consistently yields a negative average P&L across the board, regardless of the holding period. So clearly, pin bars do not provide any edge in trading against long-term trends. Forcing optimization into our analysis shows that those ideal pin bar proportions that max out profit are a tail wick of at least 55% and a head wick of at least 25% across all holding periods for long trades only. From this comparative graph, the picture does look optimistic because long pin bar trades seem to outperform our baseline in blue across the entire array of holding periods from 1 to 10. And we can further determine 8 bars to be the optimal holding period. Now, under these assumptions for our 3 parameters, long pin bars generate an average return of 0.678% per trade versus an average return of 0.29% for SPY, considering zero risk management. Bingo, right? I mean, that looks amazing on paper. We managed to improve buy and hold by at least 2.3x. Sure, but here's the rub. These setups only showed up 111 times across the 29-year sample, or 7,337 days. That's not even 4 trades per year, or roughly 2.58% per annum. Do you really want to trade something that in the absolute best case scenario cannot even beat inflation? I mean, you're gonna grow cobwebs under your armpits waiting for a setup here. But hey, your call. Now factor risk management into the equation, and that average pin bar gain drops from the headline 0.678% figure to merely 0.321% or 1.22% per year. In my book, that is totally useless. And remember once again, this paltry result is the absolute base case scenario attained with the maximum benefit of hindsight, which itself is unrealistic in the first place. Moving on to gold. These tables reiterate right off the bat what we noticed about the S&P 500. You cannot apply pin bars to gold on the short side either. Heavily optimizing provides best-in-class pin bar proportions of within 50% for the tail wick and 5% for the head wick. Although less obvious than for the S&P 500, this comparative chart shows that average gains across the 1 to 10 bar holding period slightly but consistently outperforms the underlying, and without any risk management. Our ideal holding period here is 6 bars, which also means 6 days by the way in case I did not make it clear enough so far. Using these 3 parameters, we managed to improve our return per trade over our baseline by a factor of 1.62x from 0.234% to 0.381%, still without any risk management. Our issue remains the same though. These setups only occur over 310 signals out of the 4,359 possible data points. Sure, that's a bit better than with the S&P 500, but we're only trading 310 times in 17.3 years. That's roughly 18 times per year or 6.82% per year, once again under the absolute base case scenario. Now this figure drops to 6.36% when applying stop losses. That's decent. Obviously still not usable given the heavy optimization required to get there, but the headline return is somewhat decent for an insurance asset like gold. Now, will you really be able to reproduce that result in the future? That's highly unlikely. Considering that this result was achieved by torturing data and cherry-picking the absolute base case scenario, it is actually pretty poor, and we should have been able to reach a much higher output. Next up, oil. Same process, but the tables indicate less clear of a picture as far as the long and short bias. So since we're brute forcing optimization in order to find the best possible pin bar configuration, we're going to pick up both long and short trades this time. With this, our best pin bar proportions come up to within 60% for the tail wick and 25% for the head wick. Now as you can see from this chart, the edge is much more chaotic across the entire holding range. The best holding period that we can find here is 7 bars, which delivers, using our chosen pin bar proportions and without using any stop loss, an average return of 1.546% per long trade over 57 trades and 1.43% per short trade over 45 trades. That's a total of 102 trades out of those 5,717 data points spanning 22.7 years, or 4.5 trades per year on average, generating a grand total of roughly 6.72% per year without risk management. That number drops to 4.43% when applying a stop loss. Once again, nothing to write home about here, especially since we totally reverse engineered that sequence to be optimal. No trading costs were factored in, and all other combinations are necessarily worse. Lastly, let's take a look at the Forex market with the euro-dollar cross. Here, unsurprisingly, there is no bias between long and short as shown by these tables. Long and short performance figures remain fairly balanced. We identify our optimal proportions to be within 50% for the tail wick and 25% for the head wick. With that, we're necessarily getting a much better performance than mere buy and hold, which is essentially a wash to zero. So not a major feat here, since merely getting anything positive means beating the market. That is the state of affairs that the graph is depicting. Evaluating whether pin bars are worth it rests more on absolute results than relative ones in this particular case. We identify our best holding period to be 8 bars, and combining all of these parameters gives us an average gain per trade without risk management of 0.309% on the long side over 134 trades and 0.249% on the short side over 121 trades. That's a weighted average of 0.28% return per trade over 255 trades and 6,056 data points, or almost 25 years, which converts into 10.73 trades per year, or an average annual return of 3.01% without risk management. Now add stop losses to the picture, and the average returns become 0.176% for longs and 0.229% for shorts, which translates into an overall average annual return reduced from 3.01% to 2.16%. That would equate to something like 237 pips per year on the euro-dollar pair. Now I know what you're thinking. Well, this test is actually not bad, and despite the less than tradable trading frequency, the over-optimization and the low statistical significance, I would definitely agree with you. How do we compare it against a fair baseline, that is? A fair baseline in Forex trading is actually not buy and hold, because there is no inherent value creation from just holding, as is the case with equities, for example. In Forex, the true buy and hold baseline is actually a synthetic position called a swap, meaning a combination of a spot trade and an opposite forward trade. The goal for that strategy being to capture the interest carry, meaning the rate difference between two currencies, and without incurring the risk of the FX rate changing until the swap's maturity. Now if we stack these swaps against pin bars, we realize that our 237 annual pips are now competing against a passive strategy that has generated between 102% and 1.20% per annum over the course of our sample's life, or between 112 and 132 pips per year. So now, our best possible pin bar excess return really becomes about 115 pips per year, give or take. That's about 2 days worth of volatility, collected over an entire year, in the best case scenario, and without accounting for fees or rollover costs that will necessarily add up, since all of these positions will be held overnight over several days. Do I need to elaborate? I think the whole picture should be clear by now. Pin bars are yet another useless price action urban legend. These are useless for 3 reasons. First, they do not naturally work, meaning at the mathematical level. In order to produce the illusion that they could work, we had to literally data mine our way into finding a favorable outcome. That is not how viable edges are found. In fact, that is a surefire way to tell that there is no edge whatsoever to be found. Second, even if we curve fitted our results to the past in the most favorable way possible, all that we managed to extract were paltry returns, thereby making the effort of digging and waiting for setups totally counterproductive. And third, as you saw it, the extremely low frequency of actual setup speaks to the fact that this absurd curve fitting led to very little statistical significance. These 3 points do nothing but guarantee that pin bars are nothing but a very fragile trading tool from which any derived strategies will likely crash and burn rapidly once traded live. So if you keep trading this kind of nonsense and can't manage to become profitable with it, at the very least now you know why, and objectively so. And you simply can't hope to outsmart a weak long-term trading expectancy by the sheer power of making judgment calls. It just doesn't happen that way. Now, having said all that, I am under no illusion that this quantified study will turn the price action cultists away from pin bars and at least wonder about the validity of the rest of the nonsensical concepts that they trade. Only those driven by the self-respect to put data before their ego will take notice. And if you happen to raise the findings of this study, here's the number one strawman argument that will be thrown back at you every single time. It's so systematic it's almost comical. Try it, you might actually get a kick out of it. you will be told that pin bars cannot be used alone, that they should be used instead using confluence with other price action tools, because piling crap upon crap churns out gold apparently. What's interesting here though, is that no matter the concept that they claim should be used in conjunction with pin bars in order to make them work, every single one of them happens to rely on nothing but subjective pattern recognition and cannot be tested quantifiably, be it support and resistance, or supply and demand, whatever that is, or whatever percentage Fibonacci retracement, etc. Basically anything goes, as long as they can avoid taking on the burden of proof. Now if you can't convince them, then confuse them, right? That's the modus operandi of all price action gurus out there. All of this BS ties into the fact that price action traders don't deal in objective truth, but rather relativistic interpretation. And that's why they lose money. On top of that, as you could see from this study, the number of opportunities provided by systematized pin bar setups were already few and far between. Now imagine adding up these confluence constraints. Assuming that we could even quantify and systematize them. Doing so would necessarily get us even less opportunities, making pin bars even less relevant and usable, not more. So in the grand scheme of things, you already know that spraying whatever added confluence snake oil on an already broken concept such as pin bars not only would not add anything to the concept, it would only make things worse, by definition. Now I'll conclude this video with a laugh, and I can tell you now, tongue in cheek, that we could have figured out how mathematically irrelevant pin bars are without even resorting to any quantified study. I promise you, let me show you. All that we had to do is realize that pin bars are nothing but a construction of the mind based on merely picking an arbitrary time frame. You see, as I described it in this video, people that would buy this pin bar would never buy this setup. Now what if I told you that both figures are 100% identical quantitatively, meaning that in actual mathematical reality, there is precisely zero difference between them. So you may ask, what sets them apart in the eyes of a price action trader then? Well, the difference stems from an arbitrary choice for whatever time frame they picked on that day. That's all. And as you can see, subjective interpretation can lead to totally conflicting trading decisions despite starting from the exact same situation. That illogical and unstable decision-making process cannot happen with quantitative trading. So is it any wonder then that trading using pattern recognition yields nothing better than random outcomes? Demonstrating this ambiguity with this picture is how we could have spared ourselves any calculation and know for a fact that we were dealing with yet another price action fluke, despite all the hype. Just like any other price action tool, pin bars are intrinsically nothing but an illusory mental construct. So do yourself a favor and get over this garbage before the market teaches you a costly lesson. I'll see you in the next video.